Hi, and welcome back to part three of chapter five. So we've talked about borrowing, we've talked about equity financing. Now we're going to talk about the relative benefits of both of those and various ways that that can be done. And really what it all comes down to is cost. Uh, Most organizations use a mix of equity and debt. The relative mix is extremely important and depends on the situation of the corporation, depends on their um, appetite for risk, depends on their potential for steady income relative to being in a volatile area, a volatile market where income has the potential for going up and down a lot. There's always that trade-off between risk and return. And we're going to do some exercises in this a little later in the course, but this is where you start to get into the finance part of the course. We're going to touch on this here. Then we're going to do a little bit of managerial type accounting, and then we're going to come back to this at the end of the course. So cost of capital, really important. What is the cost of capital? Well, the cost of debt is the interest. That's pretty simple. We can look at what we're paying in interest and know that that's what we're paying for the use of capital. Interest is really rent. It's rent on money. So if I have money and I want to let you use it, I charge you rent. Just like if I had a house and I wanted to let you use it to be a tenant in my house, I would charge you rent. Well, if I have money, capital, and I'm willing to let you use it, I want to get paid for letting you use it, and I charge you interest, which is the equivalent of rent. Um, Preferred stock, basically the cost of preferred stock is the required dividend payment. So the amount of the dividend that I'm going to pay is the cost of the preferred stock. And the cost of common stock is the dividends that I pay plus the growth in the value of the stock. Common stock is the ownership interest in a corporation. We don't have to pay dividends, but if we do, that's part of the cost. But also the growth in the value of the shares is part of the cost. So when we're looking at our various kinds of ways to acquire capital, we need to look at the costs of that capital. Generally speaking, debt is cheaper than equity. So it's cheaper to borrow money. Interest rates are less than dividend and capital appreciation rates. So in addition, debt is cheaper because debt interest rates are deductible, or they can be reduce your taxable income, whereas dividends are not deductible, and increase in value of the stock is not a deductible expense. So part of the cost of interest is absorbed by a reduction in taxes. So generally speaking, debt is cheaper, but debt has some downsides as well. So we'll talk about that. So the risk of debt is that I have to pay it back. And debt holders, creditors, have priority. They have a legal right to be paid. And they have priority over the assets of the corporation above equity holders. So they have first dibs, if you will, on the assets of the corporation. So the more debt I have, the more risk I'm taking. I have to pay them. I have to pay my interest in a timely manner. I have to pay the principal back when I've agreed to pay it back. If I default on any of my obligations on debt, the debt holders have the right to seize my assets. They can, if it's a secured debt, they can seize specific assets, and they can do that pretty easily, pretty quickly. If it's a non-secured debt, they can force me to pay, and if I'm unable to pay, my only recourse at that point is bankruptcy court. So they can force me into default, and default can force me into bankruptcy, or if it's secured, they can actually physically take possession of an asset. If we're too heavily leveraged, debt costs rise. Obviously, someone who's lending us money is looking at our ability to pay them back. If we have too much debt, if we're too risky, then they're going to demand a higher interest rate. So you may have heard of junk bonds. Junk bonds are bonds issued by companies that have poor credit ratings. They carry much, much higher interest rates. In the current market, AAA rated corporate debt, let's say a 10-year bond, is around 3%, 3.5%. Junk bond interest rates range upwards of 15%. So people are still willing to lend to high risk in high risk situations, but in order to get them to lend, we have to pay them a lot more interest. So the more leveraged we get, the bigger the risk that the borrower is taking, the higher interest rate that the lender will demand. Other ways to raise capital: we've talked about selling stock, we've talked about preferred stock, we've talked about debt, and we've talked about bonds and loans from banks. There are other things that we can use in capital structure, and here's a few of them here, which I'll go into the details on: stock options, stock rights, warrants, and convertibles. Stock options are basically an option to buy. An option holder holds the right to purchase shares of stock at a fixed price or a predetermined price at or during a specific period of time. So stock options can be issued to lots of different users. They're often issued to key employees. So CEO, CFO of a company, chief operating officer, all those kinds of people, executive suite people, often have stock options as part of their compensation plan. And the stock options are usually granted at a specific point in time at the market price of the stock at that time. So let's say I'm CEO of XYZ Corp, and shares are currently trading at $20 a share, and they just hired me. As part of my compensation package, I get a right in 2020, let's say, to buy 1 million shares of XYZ Corp at $20 a share. If I do a good job at CEO, maybe those shares are worth $30 in 2020, which means I can buy them in 2020 for $20 and immediately resell them for $30 and make $10 a share. I have 1 million shares, I make $10 million. So that's a nice thing. But the idea of stock options is we want our managers to have the same incentives to have the stockholders, same incentives that stockholders have the same goals as stockholders have. So if I'm the CEO and I have these stock options and I can do a really good job of building the company and making it grow, that $10 per share bounce is a huge incentive for me to do a good job. Vice versa, those share options, if I do a mediocre job and in 2020 the shares are trading at $19, the stock options are worthless. I can buy shares at $20 using my stock options, or I can go into the market and buy them at $19. So the stock options only have value if the market value of the stock increases above the option price. So that's a stock option I used quite a bit. Some companies use them extensively. Recently LinkedIn was purchased by Microsoft, and supposedly one of the reasons that LinkedIn wanted to be purchased or was allowed themselves to be bought, they were still a private company, was that they had been paying no, they weren't, they had gone public, but most of their shares were held privately. But their managers and their key employees were all paid with stock options, huge amounts of stock options. And in the recent past, the stock had been falling, and LinkedIn was afraid they were going to lose all their key employees because the stock options had no value, and that was a big part of their employees' compensation. So there wasn't much sense of staying if the stock is low value or lower value than my option. So there was a chance that they were going to lose all of their key people or many of their key people, and therefore selling out made some sense. Stock rights, right to buy a share of stock at a stated price, very much like a stock option. Usually the stated price is somewhat less than the current market price, and it's used to raise equity without the cost of a new issue. So current shareholders may be given the right to buy stock at a price somewhat lower than the current market price. You don't have to go through the offering process with the SEC. I give them the rights; they can buy the stock in proportion to their current shareholdings. It's a way to raise capital without going through a lot of the regulatory process. So if you own stock in a company and they issued rights, they would give you the right to buy the stock at some fixed price. If that price was below the market price, there would be an incentive to buy that stock. So when you're buying that stock, you're giving the money not to some other shareholder, you're providing additional capital to the company. Warrants, very similar to stock rights, another name. Usually their strike price is above the current price, so that the warrant would be set at a price above whatever the current market price is. And they're often offered as incentives to lenders. So bondholders get warrants sometimes, or banks sometimes get warrants. And the idea is to induce that lender to give a better interest rate. So I'm going to lend you $1 billion, and I'm also going to get warrants to buy your stock at, let's say, 10% above the current price. If the stock goes to 20% above the current price, my warrant has a lot of value. So it gives me some upside beyond just my interest payment, and that's a value to a lender. So different structure, but often companies issue warrants. And then we talked about convertibles already. Convertible preferred, so preferred stock that can be converted to common at a fixed price, usually higher than the price when the preferred stock is issued, and convertible bonds that can be converted to common stock at a fixed price, usually higher than when the bond was issued. So here you've got a fixed, you're lending money in a case of a bond, or buying preferred stock, which pays a standard rate. And in both cases, you have the potential, if the company does well, to have a capital gain in addition to your interest rate. If the price of the stock goes up, you can take advantage of that by converting to common stock from them. And the reason companies offer convertibles is that they get a lower either dividend rate or interest rate from the investor or the lender, because there's this convertible option. So it's a more attractive investment. So from the company standpoint, we get a lower interest rate. From the investor standpoint, we get the ability to participate in the growth of the company if the company does indeed grow. Stock dividends and splits. You often hear of stock splits. These things, stock dividends and splits, they have no material effect on the company. They really are just a psychological structure. If a stock is trading at $100, let me give you an example. Let's say we have a company with 1,000 shares outstanding, and you own 100. The stock splits 2 for 1. Now the company has 2,000 shares, and you have 200. You still have exactly 10% of the company at 200 out of 2,000 instead of the 100 out of 1,000. The company has twice as many shares, and you have twice as many shares. There's no change in your ownership share. There's no change in the company's equity. You didn't pay anything for these splits, so everything stays the same. All that happens is potentially the market price of your stock falls in half. So now you have twice as many shares, and they're each worth half what they were worth. The reason that companies do splits is to bring down the trading price of their stock. It used to be very, very important before the days of electronic trading, when brokerage fees were much higher for lots of stock of less than 100 shares. But with electronic trading, that really doesn't matter too much. So that's gone. But there's a psychological effect that if a stock is trading for $800, let's say, wow, if I want to buy 100 shares, that's $80,000. I'm going to pause for a second. Get a phone. Sorry, I just had an incoming phone call. People may object to there may be more buyers and therefore more demand for stock at lower prices. One good example of a company that's never split is Berkshire Hathaway, and their shares trade for, I don't know, I haven't looked lately, but $250,000 to $300,000 per share because they never split. So since the company was founded in the 60s, the company has done incredibly well, and they've never done a stock split. So now each share trades for hundreds of thousands of dollars. So that's kind of the extreme of no splits. I think not too long ago, Apple did a 5 or 7 for 1 split, so they were trading about $700, and now they traded around $100. Not much of a change in anything, just the per share price drops because there's more shares available. So there's no effect on ownership interest. There's no effect on the equity portion of the balance sheet. However, because of psychological reasons, stock splits often result in a short-term increase in the overall market valuation. So 2-for-1 stock splits, the stock often doesn't fall 50% for whatever reason. It will eventually fall to a market price that reflects the same valuation, but that often takes 3 to 6 months. Maybe it's because people said, oh, last time I looked, that was trading for $100, and now it's trading for $50. It must be a good value, or something to that effect. But at any rate, stock splits often result in a short-term increase in the valuation of a company. Reverse splits are something that happened a lot after the last Great Recession, so-called, from 2008, because many stocks fell so much that they were in danger of being delisted from stock exchanges. The New York Stock Exchange won't trade stocks that are below $2 per share. So if your stock is falling to the point where it's bordering on $2 or less than $2, you can do a reverse split. So all your shareholders who owned 100 shares now own 50 shares. That's a 2-for-1 reverse split. And presumably the value of your stock will double at that point. The per share value of your stock will double. So that's a reverse split. You see that sometimes. Other ways to obtain capital, or many ways to obtain capital: venture capital, public stock offerings, which we've talked about, private stock placements, which we'll talk about in a little bit of detail, debt, and leasing. All of these are ways to obtain capital. So venture capital generally provide money at the early parts of a company. They provide risk capital or to get the business started. So I've got an idea, I've got a really good business plan, and I go to venture capitalists. They take a significant share of the business and provide the capital. Oftentimes they demand management oversight. As a time when I was an entrepreneur, I was not a big fan of venture capitalists because they really wanted to run the businesses. And being an independent sort, I didn't really like that. But they do have capital and they can provide capital. And if you're in a position that you want to grow a company and you want to grow it fast, they provide that risk capital. Their model, their business model is they're investing in multiple startups. They hope that they hit on 1 or 2 out of every 5 investments, and that those 1 or 2 out of every 5 will pay for the 3 to 4 that don't work. Failure rates on new ventures are quite high, but Every once in a while, a new venture does extremely well, and if you're an owner of a new one that does really well, you do very well as well. So they generally take a big share of the business, and they also often demand management oversight. Seed capital often comes from the entrepreneurs themselves or their friends and family. You need some kind of seed capital in order to start the business, to write the business plan, to take to your venture capitalist, or to seek money from banks or whatever. You need to have some base seed capital to start any business. Now, like some of that may be sweat equity, sweat capital, your own labor and effort, but you usually need to have some offer currency, some money to start a business, pay consultants, do whatever it is that you need to do in order to get the business off the ground. So that often comes from the business entrepreneur himself, him or herself, or friends and families of the entrepreneurs. When you raise seed capital, then you go to venture capitalists to get working capital or sometimes acquisition capital. So I've got a business plan, and my business plan is to acquire a bunch of businesses in this area and consolidate them. And to do that, I need capital. I may go to venture capitalists for that. Once I've established the business and I have a real operating business that has prospects, I can issue stock to the public. It's costly and time-consuming and complicated to do that. Initial public offerings have to be approved by the Securities Exchange Commission. There are all sorts of rules and regulations that you have to follow in terms of issuing new stock. And in addition, you need underwriters. You need major investment firms who are going to underwrite the new stock offering and essentially sell it to their clients. So they're going and they charge for that. So it's a big effort, and it can be very worthwhile. So when we first offer stock to the public, we call it an initial public offering, and then later on we call it secondary issues. There are big advantages to going public. You have a much larger equity base, makes it easier to borrow as well. So and issuing bonds and so forth becomes a possibility. So real advantage to that in having gone public, you can access many more people for capital. You're definitely more recognized publicly, which can be a positive to a business. And the initial owners get to cash some of their investment out. So there's more liquidity for the original owners. Generally speaking, in a privately held business, selling the owner's share is difficult. Nobody wants to be a minority holder while somebody else holds the majority. So an entrepreneur going public provides a way for an entrepreneur to take cash out of the business, to sell some of his share, his or her share of the business. The disadvantages, it's expensive. You have not only initial costs of going public, but then you have ongoing reporting expenses. You have to live up to the Sarbanes-Oxley Act that we've talked about and all of the SEC regulations. You generally lose some control, even if you maintain control of the company in a real sense. If you've got public stockholders, they're looking over your shoulder, so you lose some control. Public stocks generally, except most people think that stocks that are traded publicly have shorter time horizons. So we're not able to look way down the road because we have to make earnings this month or this quarter or this year. So we have a shorter viewpoint in terms of our success. And finally, there's liability for officers that we've talked about under Sarbanes-Oxley. Another ways to raise money with stock is what's called a private placement. So I sell stock directly to a few large investors as opposed to going for a public offering. These are much simpler. The regulations are much easier to accomplish, and I only have a few people to answer to, not a bunch of stockholders. So I might go to, I don't know, Prudential Insurance and Liberty Mutual Insurance and Blackstone Investments and Fidelity Investments with a private placement for my stock, and each of them takes, $5 million or $50 million of stock. So I've raised, if they each take 50 million, I've raised $200 million by selling stock to 4 parties. That's a much cheaper way to go about raising funds than selling $200 million of stock to the public. It has some advantages. You can only sell to what are called sophisticated investors, which are defined in the SEC regulations. The 4 companies I just named would certainly qualify as sophisticated investors. There are some private individuals that would also qualify as sophisticated investors, not just firms. People who know the risks, so they don't need all of the disclosures that are required in public offerings. So private placements is an option for capital for some companies. And then bond offerings, they can be also issued through private placements, and often are, or public offerings, the same way stocks are. So both bonds can be issued both privately and or publicly. They're a good alternative to bank financing because they can be for very large amounts of money in some cases. They can extend for very long periods of time, 10, 20, 30 years. And because the banks aren't involved in bonds, generally speaking, I'm going to get a lower interest rate, to have to pay a lower interest rate, and the buyers probably get a higher interest rate because there's no middleman in the middle. The final way that companies access capital is by leasing. And finance leasing is virtually the same as borrowing with a different structure. So I need an asset and I go and lease it. And the finance lease basically says I'm going to lease it for 5 years, and then at the end of 5 years I end up in an ownership position, which means I can acquire the asset permanently for less than market value. That's a finance lease. An operating lease is more of a rental. I get to use the asset for a year, let's say, and then I can renew the operating lease the next year. But at the end of that period of time, I don't have any ownership interest. So those of you who have rented apartments or houses, those are operating leases. You pay the rent for a year. At the end of the year, you don't have any ownership interest in that piece of property. You leave, you stay, you keep paying rent. Finance lease is more like I'm going to buy a backhoe, let's say, and I find my backhoe, and the dealer agrees to lease it to me for 5 years, and at the end of 5 years I can purchase the backhoe for $1,000. So I pay my lease payments over the 5 years, essentially borrowing the money and paying a loan payment, but we call it a lease, and at the end of 5 years I have an equity interest. I can buy that for $1,000. I don't have to, but I can buy it at a way below market price. So leasing works much like borrowing. Industries that use a lot of leasing, the airline industry leases almost all of its planes. So most airline companies do not own their planes, they lease them. They may own some, but a majority of their fleets are often leased. So leasing is used in some industries a lot. Chartering ships for a ship company would be the same. That's a different word for the same thing. We're going to lease our ships. So if for instance, TDW had leased ships instead of owning them, when the market turned down, they wouldn't have had to, they could have just canceled the leases as opposed to, or the charters, as opposed to being stuck with the debt on these ships that they purchased. So a lower risk strategy, if you will. Okay, so that wraps up chapter 5. There'll be some short questions after this, and then we'll be moving on from there. Thanks.